I've seen seven-figure traders trade the opening range strategy and be successful at it. And when I tried it, I kept on losing trades and I was wondering why. The thing is, when they teach this strategy, they fail to mention the conditions and tips that help you increase your win rate and eliminate some losing trades. After months of trial and error, in this video, I'm going to be sharing 2 conditions so that you can execute your trades in 3 simple steps and increase your win rate significantly and stop overthinking like I used to.
Before I go over this strategy and the conditions that need to be met before we take any trades, I want to go over why most people trade this strategy. It is repeatable. In trading, once you can find something that you can repeat multiple times, it becomes second nature to you and it just reduces analysis paralysis. You're not overthinking and you can execute it in 3 simple steps. No more overthinking, no more wondering, where do I enter? Did I enter late? And second guessing yourself. I know I'm going to get this question, so I'm just going to answer it now. Yes, it works for crypto, forex, stocks, and futures. Now I'm going to go over the conditions that a lot of traders fail to mention when they teach this strategy. I don't know why they don't, but I realize that certain conditions need to be met so that you have a higher probability of the trade working out. Condition number 1 is that there has to be a clear trend. If you don't know what a trend is, in an uptrend, you want to see higher lows and higher highs being built. And in a downtrend, you want to see the opposite, lower highs and lower lows. What you do not want to see is consolidation, aka chop, because that reduces the chances of this strategy working out. Once you see price stuck in a range, there's a high chance that this setup will not play out. Second condition is you don't want price to close below the opening print at any point while you're waiting for this setup to appear, or for the bearish setups, you don't want price above the opening print at all. You don't want to see price open up here, then go higher, right? And then you're trying to find a way to trade the downside. For upside, you want price to stay above the opening print and then show you that it has formed a trend by forming, higher highs and lower highs as it builds. Now, I'm going to move on and show the first step. First step is to mark out your key levels. You're doing this by watching the first 5-minute candle play out, and you're watching the 5-minute time frame. You're watching the first 5 minutes because that's when you have the most volume. And if you're a momentum trader and you're trying to catch quick moves to the upside or downside, you want to see where buyers try to push the price higher or lower. And those first 5 minutes tell you sufficient information if you're trying to scalp and just catch a piece of the move. Once you have done this, you then want to look for direction. What direction is this going to play out? For example, you now move to the 1-minute time frame and you're watching to see if price breaks to the upside or if we end up breaking down to the downside. In this example, as you can see, price opens here and it pushes higher and then forms that 5-minute high. And as it pushes back down, it forms a potential higher low. Pretend you haven't seen this candle yet. It's called potential because at this point, we haven't broken this high. We are basing, buyers are stepping in, and then we're trying to continue the trend. Once it breaks this high, this higher high right here, and forms a new high, this then becomes a valid higher low that you can then take off and say, yes, there's a trend. The trend is clear. Now, you're not just going to rush in and buy this breakout because that's what some people have thought, that, okay, just buy this breakout. And here's the thing, if you're trading options where your risk is not your risk is not clear and you have to do calculations based on the delta and how price moves within a specific time period, right? You would end up entering this trade, and what happens is that you see a pullback retracement to retest that 5-minute high. I have found that the best entry is always to wait for the pullback. Don't chase the breakout. When you see price pull back to retest, you can now watch and see what happens. You just don't jump in. You observe the candles. A buyer stepping in. Yes, buyer stepped in to push this price to close it. You don't rush in yet because you haven't gotten confirmation. All you have right now is a signal. And I made a video explaining the best entries that I have discovered, just so that you can understand how to get the best entries. You then watch to see how price then reacts around this signal bar. Do we close above it? Right? Yes, in this instance we do, because we end up closing above this signal bar's high and engulfing the body of the signal bar. That's a sign, and that's good confirmation as well. So you got the signal, and then now you have the confirmation that, okay, buyers are stepping in and we have closed above this 5-minute range high. You can then enter the trade, right? and look for a 1 to 5 hour or a 2 hour. I have found that once those two conditions are met when you take the trade, you will most likely get a 2 hour return on the trade, and your stop loss is easily right the break below this signal bar, and you'll be able to catch a piece of the move quickly and go about your day. Some people have jobs, so they don't have the luxury and opportunity to sit in front of the desk or computer or your phone, whatever you're trading with, all day. So you want to just be in and out and be done. Now I have explained how to mark your levels, the conditions to look for, how to gauge direction, and how to find an entry, stop loss, and target, which is a must. You must have these things able to increase the probability of this setup working out. The pros and cons of this strategy. Pro number one is that you have a clear stop loss. Something I used to struggle with was that sometimes I'll enter trades and not have a clear defined stop loss, and that would cause you to hold on longer or take larger losses than you'd want to take. So this strategy gives you a clear and defined stop loss. And you should always know your stop before you enter. It's also great for catching quick moves, especially if you trade options. If you trade options, you can literally make anywhere from $50, depending on how small your account is, to it's unlimited. You can make a lot of money trading this strategy if you just have the patience to just sit and wait for it. And now I've given you the pros. I've given you the pros. The cons of this strategy: the retest does not always happen. For example, in the downside move, you might not always have that perfect retest because, like they say, it's a staircase effect to go up. But when stocks are selling off, it's always faster. Moves happen faster. Elevator down, staircase up. Another con is that it has a low risk to reward in choppy markets. But you can eliminate this con if you just avoid trading in sideways choppy action, like I explained earlier. I'm not going to end this video without giving you some tips. So tip number one is you want a strong candle close above the level. Preferably, you don't want to see a big wick if you're trading the upside. You don't want to see like a big wick showing rejection and maybe a small body of green. In that case, just don't take that trade. Skip it. Number two, the trade has a higher chance of working out when it is in line with the higher time frame trend. So when you're doing your top-down analysis, say on the daily time frame, it's bullish, and then you go on the hourly time frame, it's also bullish, and it's a clear uptrend. And then you do this analysis of waiting for the first 5 minutes, and you're trying to take a trade. You've increased the chances of the trade working out from 80% to like 90%. And if you're a patient person, I know a lot of us are not patient, but if you're a very patient person and you nail this strategy, this could be the reason why you are consistently profitable faster than most people. Number three, if the retest takes more than 30 minutes to set up after the break, momentum is likely gone and it's slowed down. So the chances of that trade working out drops quite significantly. So you want to exercise caution. And this brings me to my final point of context. By context, I mean maybe you're trading individual names like Nvidia, or you're trading a currency pair, or you're trading crypto. You have to, context is like, okay, what market conditions exist? Do we have FOMC this week? Do we have any news? Do we have data coming out at 6:45 or at 7 o'clock? There are times where you have to use your experience, because you only learn and gauge context with experience. That comes with experience and time you've spent in the market to know, okay, this might not play out today. This 5-minute setup might not work out today. Let me look for something else, or let me skip the trade entirely. So context plays a huge role to be able to increase the chances of seeing success with the strategy. That's it for this video. Thank you so much for watching. I'll see you on the next one.